Hey friends, today we are diving into the world of investing with a focus on a legend in the field. Yes, Peter Lynch. This guy is not just any investor, he is a rock star in the world of finance. He is best known for his work as the manager of the Magellan Fund at Fidelity Investments, where he achieved an incredible track record. Under his management, the fund assets grew from 20 million to 14 billion dollar between 1977 and 1990. That's a massive growth. One of the coolest things about Peter Lynch is his approach to investing. He believes in investing in what you know, which means looking at companies that you are familiar with or products you use every day. It's like if you love eating at a certain restaurant because their food is delicious, Lynch might say, hey, maybe that company is worth investing in. Now let's talk about his famous fair valuation formula, also known as PEG ratio. It stands for price per earning to growth ratio. It's a handy tool that helps you figure if a stock is priced just right, too expensive, or maybe hidden bargain. The PEG ratio looks at the stock's price, compares it with the company's earnings, and then takes the company's growth into account. In simple terms, it helps you to understand if you are paying a fair price for a company's growth prospect. Imagine you are shopping for a new bike. You want the best deal, right? So you look at the bike's price, its quality, and how much use you will get out of it. The PEG ratio is something similar but with stocks, helping you to decide if a stock is a good buy. So why do we care about what Peter Lynch has to say? Because he has proven that the bit of research and a sensible approach, anyone can pick winning stocks. His strategies and insights can be a big help for folks looking to grow their money in the stock market. Alright, so let's get ready to explore more about Peter Lynch's approach and how using his fair valuation model might just make you a smarter investor. Who knows? You might find your own gem of an investment just by following his advice. Let's dive in. This is Sundar and you are watching Mindful Finance. Okay, let's get into that. So Peter Lynch formula is very simple, and I try to make it very much simple, and you can use it in Google Sheets. I tried to find out easy method to automatically capture the data, but I couldn't able to. But I'm working on that. Soon I would be able to help you out in everything happens. You just apply the stock name and everything it recommends what to do. So that kind of Excel I'm trying to work it out. Even though this is a version 1, so you can still use this skill sheet for your finding the valuation of the stock. To get into that Peter Lynch formula, Peter Lynch, what he says is he's having a two formula, which is two formula in the sense two way of approach. One is non-banking sector and one is banking. Because the reason behind is bank will have more debt. So bank is more of calculated based on book value rather than just focusing on the PE, right? So that is the key point. So let me show you the difference. So this is the formula you can see over here. Formula for calculating Peter Lynch fair value non-banking company is this, and this is for the banking. The difference is for the non-banking you will have a PEG ratio, certain value, but here in the scenario of banking we'll assume the PEG ratio as 1. So what is PEG ratio? PEG ratio is, as I mentioned the initial one, PEG ratio is nothing but price to earning to the growth. So that is the ratio we arrive for. So using this details or using this value, let's find out the valuation of stock. For example, let me check banking stock. For example, let's say Karnataka Bank. So using a Google Finance formula, we can get the ticker. So Karnataka Bank's current price is 238. Now we need to find a PEG. Banking sector default, we are going to assume PEG is 1. EPS. So let's go to screener. So where you can search Karnataka Bank. So EPS is 43.3. Go on 43. Now PE ratio. What is PE ratio? Price to earning, right? So what is the price to earning? Is equal to current price divided by, which is 5.5. Check approximately in the screener it is showing 6.49. Or what you can do is you can pull from Google Finance. Okay, ticker is KTK Bank, comma, what you want to have, PE. We'll get PE ratio 5. Now annual earnings growth. We have, if you remember the previous video last week, I posted a video on calculating, finding the intrinsic value. So for that we have to go to Yahoo Finance. So Yahoo Finance, you search for Karnataka Bank. You can find it NSE or BSE. So you have to check both. So where you will find, you have to figure it out. Okay, let's first try NSE, whether it is there or not. If you go to NSE, the Karnataka Bank, here in the analysis section, if you go to analysis, you will find the data. So here in the scroll down, you'll find next 5-year annual growth, which is 22.8. The same thing you can find in screener also. EPS growth Yeah, next 5 years 29.2. In Yahoo Finance it is showing 22.8. So we'll go with the 22.8. So we need to be more conservative. So let's go to formula. Our growth rate is 22. Okay. Now EBITDA. EBITDA means earnings before like tax, depreciation, amortization, whatever it is, right? So all the loans, everything, whatever the earnings you had, you have to minus all those things. Before that, how much your earnings would be. Before deducting all those, before the deductions, whatever the amount you are earned. So that is what EBITDA. So EBITDA, how will you find? Again, go to screener. So come here in the chart area, click on more, go to EV/EBITDA. The line is EV and this is the bar charts are EBITDA. So if you see the past 1, 2, 3, 4, you'll find approximately see this line 14.8, 15. So let's take 15 in an average. EBITDA average is 15. Now Peter Lynch fair value formula. What is the Peter Lynch formula here for the banking sector? EBITDA into 5 years CAGR that is EBITDA into EPS TTM. Okay, EPS is we have already kept. Peter Lynch fair value is equal to, so 1 is our PEG ratio, 1 into 5 EBITDA, what is that, EPS, you get 649 points. So now you need to check this is greater than or lesser than the current value. Current price is 238 and the Peter Lynch fair value comes around 649. So that means signal is buy. This is the banking sector. So similarly, let's check for non-banking. So let's see Infosys, NSE. Last time also I told you, if you just put Infi, it will not come. It will go to the US. So put NSE : Infi, you will get proper value. Current Google Finance. There is. So this is the current price. Now let's see EPS. What is the EPS info? Search for Infi. What is the EPS? 58.8. Come here. 58. PE ratio. Again using the Google Finance. You can get the PE ratio. Ticker is this one. Comma PE. Close bracket P. You can check 25.10. If I go to screener, P is 25. Okay. Then annual earning growth. For this, as I mentioned, you can check here also, which is EPS growth for 5 years, which is 9.79. Let's see what is Yahoo Finance showing. Infosys. Check the NSE, go to analysis, come down 8.8. Let's go with this one, 0.83. Now, what is the PEG ratio here? PE by annual earning equal to as a PE divided by annual earning. So this is your, what is EBITDA? Let's go to the chart again. EBITDA, can more, go to EV, EBITDA, and see these are the average 1, 2, 3. Let's see approximately 15, 15, 14. So approximately, sorry, this is the bar, okay, 26, 24. It is between 24 and 25. So what is the, so you can approximately say 24. Okay, let's go and say EBITDA is 20. Now go to our fair value calculation equal to PEG ratio PEG into EBIT into PS. Okay, so 4,000. So this signal is buy. Hope you are able to get it right. So let's check the what do you say, Karnataka bank. I think I made a mistake in finding the EBITDA. Karnataka. So average is 17.5. Okay, we have 17.5. Okay, not a big difference. I have put less only, like 17. So still it's a good value. So this is how you have to calculate and you have to find the valuation. You understood. And as I mentioned in the intro, Peter Lynch clearly says that pick a stock which you really understand that company and what it does. This is just a formula to understand whether it's a good buy or not. Understand until if you are not clear with the company and what it is doing, don't just blindly go with this formula. This is the final step you have to do. So intrinsic value calculation I shown in the last video. So that is one method, and this is another method. So another couple of methods are there. I'll try to cover in other videos. You can try all this valuation method to arrive a conclusion instead of just focusing on one method. You can arrive the valuation in with. So this another is a depth using the what is it, dividend based valuation is there, and discounted value valuation is there. So couple of Dando is there. So multiple valuations are there. I'll try to cover one by one. So this is the second method. Just understand, and again I'm saying that just understand, and I'm repeating this again. This is the last step you have to do. The first step is finding the business which you clearly understand. If you don't understand the business, please don't get into this level of details. First, try to understand the business, understand the moat of the business. For example, if there is a, I don't know whether you have read this book, Dando. This is by Monis Pabrai. Monis Pabrai is an inspiring person. You can hear his interviews and videos, what he talks about stocks. One of the very interesting insights, what he mentioned is, he gives an example. If I give you, or your family, say family can handle, gives you 4 crore rupee, okay, and say the company Apple is 1 crore company, okay, will you buy that Apple company with 1 crore? Because you already have 4 crore. In that 1 crore, will you buy Apple? If you have the gut to do that, then get into the stock. else don't pick the stock. Hope you understand what I mean. That means you will buy a business only if you have confidence, because the money is something that you don't like to lose. The stock market currently, we have everything in mobile, buy, sell, everything happens quickly. So we don't think all this kind of a thing, and we just get biased with our opinion from others like influencers. All those guys will come and tell you, and based on that you buy a stock. Please don't do that. You do your analysis. That is what the mindful finance is all is about. Don't rely on others. Hope you like this video. If you like it, press the like button, subscribe it, and share it with your friends. Thank you.